In 2009, two brothers from outside Chicago sat down for Thanksgiving dinner at their parents' house. Neither one wanted to talk about money, but it came up anyway. It always does at family gatherings during a crisis. Robert was 54, 28 years in pharmaceutical sales. He had $740,000 in his 401k at the start of 2008. By Thanksgiving 2009, it was sitting at $387,000. He had lost $353,000, more than half his retirement savings, gone in 14 months. He was staring at his plate, doing math in his head. At this rate, he would have to work until 70, maybe longer. His advisor kept saying the same thing: stay the course, don't panic, it'll come back. But Robert was 54 years old. He did not have 20 years to wait for it to come back. His younger brother Gene was 49. Same parents, same upbringing, same middle-class neighborhood. Gene had never made as much money as Robert. He had bounced around, sold insurance for a while, ran a small landscaping business, never had a financial advisor, never maxed out a 401k. By every traditional measure, Gene should have been in worse shape. But Gene was calm, suspiciously calm. Their mother finally asked, "Gene, how are you holding up with the economy and everything?" Gene shrugged. "I'm actually doing okay, Mom." Robert looked up from his plate. "What do you mean you're doing okay? Nobody's doing okay." Gene explained, in 2001, after watching their father lose a third of his retirement in the dot-com crash and then spend the last 5 years of his career trying to claw it back, Gene had started studying what wealthy families actually did during economic crises. Not what they said on television, what they actually did with their money. He found a pattern that went back 100 years, 5 specific types of assets that the wealthy accumulated during every single recession. He had been following that pattern since 2002. When the 2008 crash hit, Gene did not panic, he bought. "My net worth went up last year," Gene said quietly. "Not by a lot, but it went up." Robert set his fork down. He had made twice Gene's salary for nearly 3 decades. He had a financial advisor. He had followed every piece of conventional wisdom, and he had just lost $353,000. Gene, the brother without the fancy job or the professional advisor, was gaining wealth during the worst financial crisis since the Depression. Robert spent the rest of that holiday weekend asking Gene questions. What Gene showed him changed everything Robert thought he knew about building wealth. Gene had been playing a completely different game, and nobody had ever told Robert the game existed. "I'm Ben, and I have a bit of an obsession. I dig through decades of financial data, I track what the ultra-wealthy are quietly buying when markets crash, and I study the patterns, the ones nobody talks about, that show up again and again every time the economy collapses. So if you've ever sat there watching your retirement account shrink, wondering how some people actually get richer during a crisis while you did everything you were told to do and still got burned, this one's for you." This isn't speculation. It's not a gamble. It's not hoping something goes up. It's 5 proven asset classes that have performed through every recession since the Great Depression, a full century of receipts. And the reason you rarely hear about them is simple. They don't make advisors money, so they don't get marketed to you. If this matters to you, hit subscribe right now. I'm going to keep exposing these patterns that mainstream financial media ignores. Hit that like button. It tells the algorithm to push this to more people who need to see it. Here is the thing about recessions that most people get fatally wrong. They think recessions destroy wealth. They do not. Recessions transfer wealth, from the unprepared to the prepared, from the panicked to the patient, from the people who sell at the bottom to the people who buy at the bottom. I call it the recession transfer machine, and once you see how it works, you cannot unsee it. Here are the numbers that prove it. During the 2008 crash alone, 8.7 million Americans lost their jobs, $9.8 trillion in wealth was destroyed, 3.8 million foreclosures were filed. The country was in agony. But Forbes reported that the number of billionaires actually increased from 1,011 to 1,210 between 2009 and 2011, right during and right after the crisis. More billionaires were created, not fewer. A UBS study found that more millionaires are made during recessions than during boom times, and the 2020 COVID crash created 5.2 million new millionaires globally within 12 months of the market bottom, according to Credit Suisse. So what were these people buying while everyone else was panicking? 5 things. The same 5 things every single time, going back a century. Asset number 1, distressed real estate. This asset has created more recession millionaires than any other. The logic is brutal and simple. People panic sell, banks foreclose, prices crash 30 to 50% below actual value, but land does not disappear. Populations keep growing. Housing is a basic human need. Those who buy during the fear become property owners during the recovery. Let me give you 2 examples separated by 80 years that prove the pattern is identical. Joseph P. Kennedy Sr., JFK's father, liquidated his stock market positions before the 1929 crash. He then used his cash to buy distressed real estate across New York City at pennies on the dollar. Properties he bought for $1 to $2 per square foot were worth $50 to $100 per square foot within 15 to 20 years. That real estate helped build a family fortune estimated at $500 million, roughly $9 to $10 billion in today's dollars. Fast forward to 2008, Blackstone Group spent over $10 billion buying 80,000 single-family homes between 2012 and 2016. They bought houses at foreclosure auctions for $100,000 to $150,000 that had been worth $300,000 to $500,000 just 5 years earlier. Those same homes are now worth $400,000 to $700,000. Blackstone turned that portfolio into Invitation Homes, now a $21 billion public company. An individual who bought an $80,000 foreclosure in Phoenix in 2011 is sitting on a property worth $350,000 to $450,000 today. That is a 400% to 500% return on a single house. The pattern repeats without exception. Every recession, foreclosures spike, prices crash, smart buyers accumulate, economy recovers, prices exceed previous highs, buyers become millionaires.
Now, here is where it gets even more interesting. Asset number 2. Blue chip stocks bought at crisis prices. Great companies do not disappear during recessions. They go on sale. And the S&P 500 has recovered from every single crash in its history. Recovery rate, 100%. Failure rate, 0. Let me show you what buying during panic actually looks like. In 1939, John Templeton, later called the greatest stock picker of the 20th century, borrowed $10,000 and bought 100 shares of every stock trading below $1 on the New York Stock Exchange. He bought 104 companies. Most people thought he was insane. Only 4 of the 104 went to zero. His $10,000 turned into $40,000 within 4 years, a 300% return during wartime. Templeton went on to build a $20 billion mutual fund empire. His rule was simple: the time of maximum pessimism is the best time to buy. Warren Buffett took this to another level. After the 1987 crash, when the Dow lost 22.6% in a single day and $500 billion in market value vanished in 6.5 hours, Buffett did not sell a single share. Instead, he started buying Coca-Cola stock in 1988 at an average price of $2.45 per share, split adjusted. He invested $1.3 billion total. That investment is now worth over $25 billion, and Coca-Cola pays Buffett over $700 million per year in dividends alone. More than half his original investment comes back to him every single year, forever. Think about that. $10,000 invested in the S&P 500 at the March 2009 bottom would be worth approximately $100,000 today. A 10 times return in 15 years. $10,000 in Amazon at its 2001 low of $7 per share would be worth over $30 million today. But here's what I need to be honest about. Timing the exact bottom is nearly impossible. You do not need to. You just need to buy when everyone else is selling.
The window is usually 6 to 18 months wide. You do not need to be perfect. You just need to be present. Asset number 3, gold and precious metals. Gold is the 5,000-year-old fear asset. When confidence in governments, banks, and currencies collapses, gold rises. Central banks themselves hold over 36,000 tons of gold. If they trust it, there's a reason. During the Great Depression, while stocks fell 89%, homestake mining went from $65 per share in 1929 to $495 in 1936, a 661% increase during the worst economic period in American history. While millions lost everything in the stock market, homestake shareholders became wealthy. In the 1970s, when Nixon ended the gold standard and inflation hit 14.8%, gold went from $35 per ounce to $850 per ounce. That's a 2,329% increase in 9 years. $10,000 invested in gold in 1971 was worth $242,857 by 1980. After the '08 crash, gold went from $700 per ounce to $1,921 by 2011, a 174% increase while the S&P 500 was still recovering. And gold has now surged past $3,000 per ounce in 2025. Costco started selling 1-ounce gold bars online and moved an estimated $100 to $200 million worth per month. They sold out within hours of each restock. Gold has been positive in 8 out of 9 recessions since 1970. It has returned approximately 7.8% annually since 1971. And it has zero counterparty risk. It does not depend on any company, bank, or government to maintain value. Now you might be thinking, gold does not produce income. You're right, that's its weakness. But during a crisis, you are not looking for income. You are looking for survival. And gold has survived every crisis for 5,000 years. Asset number 4, and this one is going to surprise you. Businesses started during recessions. This sounds insane. Start a business when the economy is collapsing, but the data is overwhelming. The Kauffman Foundation found that more than half of Fortune 500 companies were founded during a recession or bear market. Companies started during recessions have higher survival rates than those started during booms. An Inc. magazine found that businesses launched during the 2008 recession grew 27% faster in their first 5 years than those launched during good times. Why? Competition disappears. Weak businesses die, leaving market share open. Talent is cheaper and available because laid-off workers are eager. Real estate, equipment, and advertising costs drop 20 to 40%, and desperation breeds innovation. Let me give you 3 examples. Jan Quam was a former welfare recipient and Ukrainian immigrant. He founded WhatsApp in 2009 during the recession because he couldn't afford international phone calls. He built a simple messaging app. Facebook acquired WhatsApp in 2014 for $19 billion, from welfare to billionaire, built during a recession. Brian Chesky and Joe Gebbia couldn't afford their San Francisco rent during the '08 crash. They put an air mattress in their living room and rented it to conference attendees for $80 a night. Airbnb is now worth over $80 billion. Chesky's personal net worth exceeds $10 billion. Microsoft, Apple, Uber, Slack, Instagram, Pinterest, all founded during or immediately after recessions. The pattern is undeniable. Recession creates problems. Entrepreneurs identify real needs. Lower costs allow lean startups. Weak competitors disappear. Recovery amplifies growth. Founders become millionaires and billionaires. Now, I need to be honest here. Starting a business is not passive investing. It requires skills, time, energy, and risk tolerance. And 80% of businesses still fail, even in good times. But for those with the drive and the idea, recessions offer a window that booms never do. Asset number 5, farmland and productive land. This is the asset that has never gone to zero. It has never had a negative decade in recorded history.
and it feeds the world.
Bill Gates has quietly accumulated over 269,000 acres of farmland across 19 states. His holdings are worth over $1 billion. He started buying during and after the 2008 recession when prices were lower. When the richest man on earth chooses farmland over tech stocks as a long-term investment, you should pay attention. Here is the data. U.S. farmland has returned 11.5% annually over 50 years, according to NCREIF data. It has had only 3 negative return years in that entire period, compared to 12 for the S&P 500. During 2008, while stocks fell 57% and housing crashed 34%, farmland values actually increased 6%. It was one of only 3 asset classes with positive returns that year. The mechanism makes sense. People always need to eat regardless of economic conditions. Land is finite. They are not making more of it. Global population is heading toward 9.7 billion by 2050. We will need 60% more food with roughly the same amount of farmland. And farmland generates rental income of 3 to 5% annually on top of appreciation. For regular investors, you do not need to buy a farm. You can buy farmland REITs like Gladstone Land, ticker LAND, or Farmland Partners, ticker FPI. Shares cost less than $20, no accreditation needed, dividends paid from farmer rent. It is the simplest way to own the same asset class the billionaires are buying. Now, here is why all of this matters to you specifically. The United States has experienced 12 recessions since 1945, roughly one every 6 to 7 years. The average recession lasts 11 months. The average expansion lasts 64 months. That means recessions are short, violent, and predictable in their existence, if not in their timing. If you have a 401k, an IRA, a pension, or any retirement savings, you are going to live through at least 1 or 2 more recessions. That is not pessimism, that is arithmetic. And when those recessions hit, wealth will transfer. It always does. The only question is whether it transfers to you or away from you. Right now, most people's portfolios are designed to grow during good times and bleed during bad times. That means every 6 to 7 years they give back a massive chunk of their gains. The people who build lasting wealth have portfolios designed for both environments. So what do we actually do with this information? Look, the first thing we need to talk about is cash position. Every single recession millionaire in history had one thing in common. They had cash available when prices crashed. Not all their money in cash, but enough to act. If 100% of your wealth is locked in index funds and 401ks with no liquidity, you cannot buy distressed real estate at 50 cents on the dollar. You cannot buy blue chip stocks at crisis prices. You are just watching. If I were in your position, I would be building a cash reserve specifically earmarked for recession buying. Not your emergency fund, a separate pile of money whose only job is to be deployed when fear peaks and prices crash. Even 10 to 15% of your portfolio kept liquid gives you ammunition when everyone else is frozen. Now here is where it gets interesting. You do not need to wait for the recession to start positioning. Gold has historically risen before and during crises. You can start accumulating now through physical gold, gold ETFs like GLD, or gold mining stocks through GDX. This is your insurance policy that also tends to appreciate. Farmland REITs like Land and FPI are available right now at reasonable valuations. They pay dividends while you wait. They have historically held value during downturns. This is money working for you regardless of what the economy does. Consumer staples and blue-chip dividend payers like Procter & Gamble, Coca-Cola, Walmart, and Costco tend to decline far less during recessions and recover faster. You can start building these positions now through individual stocks or the XLP ETF. And for distressed real estate, the play is patience and preparation. Build relationships with real estate agents who work foreclosures. Learn your local market. Get pre-approved for financing. When the next recession hits and foreclosures spike, you want to be ready to move, not scrambling to figure out how real estate works.
But here's the thing. This situation is always fluid, so you need to be watching for signals. The yield curve is your early warning system. When short-term rates exceed long-term rates and then normalize, recessions typically follow within 12 to 18 months. We have already seen this pattern play out recently. Consumer confidence is another key indicator. When the Conference Board Consumer Confidence Index drops below 80, historically that has coincided with recession onset. Watch it monthly. And unemployment claims. When initial jobless claims start ticking up consistently, that is the recession knocking on the door. That is your signal to accelerate your preparation. When you see 2 or 3 of these signals flashing at the same time, that is when you want your cash reserves fully loaded, your watch lists ready, your financing in place. Because when the fear peaks, the window opens, and it does not stay open long. Now, I am not saying you need to liquidate everything tomorrow and sit on a pile of cash waiting for the apocalypse. That is not the move. But what I am saying is you need a plan. Because when this thing moves, it moves fast. The 2020 crash took 23 trading days. The 2008 crash unfolded over 17 months. The window to buy was there in both cases, but only for people who had already decided what to buy and had the resources to do it. Let me bring this back to where we started. After that Thanksgiving in 2009, Robert started following Gene's approach. He did not abandon his 401k, he did not do anything reckless, but he carved out a portion of his savings and started positioning across these 5 asset classes. Gold, a small rental property bought at a foreclosure auction in 2010. Blue-chip dividend stocks bought during the fear. Farmland exposure through REITs. By 2015, Robert had not only recovered his $353,000 loss, he had surpassed his previous peak. And for the first time in his career, his portfolio was generating monthly income regardless of what the stock market did. More importantly, when COVID hit in 2020 and markets crashed 34% in 3 weeks, Robert did not panic. He did not call his advisor in a cold sweat. He bought, because he had been through this before. He understood the pattern, and he had cash ready. Gene had taught him the game their father never knew, the game that wealthy families had been playing for 100 years. 5 assets, every recession, the same pattern. Wealth does not get destroyed during recessions, it gets transferred, from the panicked to the patient. The only question is which side of that transfer you're going to be on. A Ramsey Solutions study of over 10,000 millionaires found that 90% built their wealth through asset ownership, not salary. They did not out-earn their way to wealth, they out-positioned their way there. And the single greatest positioning opportunity in any lifetime is a recession. The average American will live through 8 to 10 recessions. Each one is a wealth-building window disguised as a catastrophe. The people who understand this build generational wealth. The people who do not spend their lives recovering from losses that could have been gains. Here's what I want you to take away from this. First, start building your recession war chest now. Cash reserves, gold positions, and farmland exposure you can accumulate today before the next downturn makes them expensive. Second, build your buy list. Know exactly which distressed real estate markets you would target, which blue-chip stocks you would buy at what prices, which assets you would accumulate. Do the research now so you can act fast when the window opens. Third, watch the signals. Yield curve, consumer confidence, unemployment claims. When these start flashing, accelerate your preparation. The next recession is coming. It always does. The average cycle is 6 to 7 years. The wealth transfer machine is going to activate again. And when it does, you need to be standing on the right side of that transfer. If this changed how you think about recessions, if you finally see them as opportunities instead of disasters, do me a favor. Share this with someone who needs to hear it. A spouse, a friend, someone who is still terrified of the next crash instead of prepared for it. We do not talk about this enough. The financial media covers recessions like funerals. They should be covering them like sales events, because that's exactly what they are. Everything goes on sale, and the people who buy during the sale become the next generation of millionaires. Hit subscribe, because we're going to keep breaking down these patterns. Stay sharp out there.